Hey, it's Andreas. I've been investing for over 10 years. In today's video, let's take a closer look at TransMedics Group. This company, it's an organ transplant company in the US. We can see them here second on the search result. If I search for organ transplant companies in the US, number one is a non-profit, so they're not likely to be able to meet demands. TransMedics, the first for-profit company that shows up in search. How has the company performed? Well, if we look at the latest 5 years, we can see that they have performed amazingly well. This niche company has the potential to have a moat, to protect profits, to have greater margins as a result of less competition, and we absolutely hate competition. That's a quote from one of the founders of Palantir here, Peter Thiel, and in this case it holds very, very true. So smaller companies, niche industry, I think it's a good bet for potential above market returns in the future. We see that there's been a substantial drop in share price as well. They had some disappointing earnings here last time with regards to growth. We will look at that as well. If we look at a year-to-date basis, we can see that despite them having dropped some here in share price, they're still up about 5% year-to-date. Market cap 2.7 billion as I'm recording this video, and then they are profitable, so they have a price to earnings ratio. If we take a look at the income statement real quick and zoom out to annually here, we can see that revenue about 3x from 2021 to 2022. Then it slowed down a bit from 2022 to 2023, but still more than 2x. And if we just look at the numbers and understand the trajectory, we can see that the third quarter here was actually a slight decline compared to, just the quarter before. And with a small company, only 2.7 billion, it would be nicer to just see more growth. It could be cyclical. It's better to compare quarter over quarter. However, with a price to earnings ratio like this and the growth being so high in the past, it would have been a lot nicer just to see faster growth in this case. About 100k, 300k, we compare to annual, we see, alright, they already have a nice increase compared to the full year of 2023. However, it needs to be faster, it needs to be closer to that 3x number. And we also saw the CEO give a lot wider guidance in the last one, and the street consensus will be, that they're gonna miss a little bit. And I think that this miss in expectations is what's causing the stock price to drop. Because remember, in the financial models, one of the most important inputs is growth rate when we do the discounted cash flow analysis and bring back all the future cash flows to a terminal value, what's it worth today. And if growth rate drops, well, then the valuation drops a lot very quickly as well in this case. And that's what we've been seeing here for this stock. When growth slowed down, then the stock price declined by a lot. It's about 50% cheaper here compared to the peak. So it could potentially be a sale if they're able to turn a growth rate around. I don't know if they have hit a cap in terms of the business, in terms of scalability, if they don't have enough hospital beds or doctors, or if there's something that they need to solve in order to get to that next stage of growth and continue to grow until they hit a cap once again. But they seem to be constrained in their operations somehow right now, trying to solve it. I don't think that it's related to demand. I think more is related to the operations sides regarding this, but quite interesting. Is there any knowledge that we can bring in from other industries to this? Well, we've been following along medical properties trust here, the healthcare sector lately, looking at the quarterly earnings reports, and they spend a lot of time talking about the health of the tenants in that case, and that the hospitals, the operators are really bouncing back from the COVID times and that they're seeing stronger results, better business. So we know that the tide seems to be rising in the healthcare industry. It seems to be a lot more demand now, once again, and a rising tide lifts all boats, so this should be good for TransMedics Group here as well. However, are there some sort of blocker on operations right now that's preventing quick future growth? We need to find this out, because if they are able to get the growth back in line with previous numbers and grow as quickly, well, the stock price is cheap right now and it will bounce back nicely. However, if they're unable to increase growth rate on the top line, then they are quite expensive indeed. Just looking at 2.7 billion in market cap, and then even comparing top line, let's say that they do about 400k. Okay, this is in thousands of dollars, so about 400 million here for the full year. Is that something that you want to pay for this top line with the margins that they have? I don't think it's too bad. I think it's getting on the cheaper end right now, with the potential for growth accelerating. 400 million for, let's say that they get that in the year. You pay 2.7 billion for the company. They are profitable. Very, very nice. Oh man, this is a tough one. I think that the odds, the risk to reward ratio, is that they have the potential to do above market returns. They're a smaller company. It's gonna be riskier than an index fund for sure, a lot riskier, but there's potential to make a lot of money here for investors. So I think that this could be a nice pick. It's a very interesting one. I think that if you have knowledge about this sector with organ transplants and you can understand the operations side of it a bit better, well, then you can make a more accurate decision regarding the risk to reward ratio in this case. For me, I don't know enough about hospital business to be able to take a gamble on a stock like this. Although in terms of valuation, just looking at the revenue that you get, compare it to the total value of the company. I've looked at profitability. They've had profitability for 4 quarters in a row on an earnings per share basis. We can take a quick look at the balance sheet as well, just real quick as a bonus for you guys. I don't think there's going to be anything strange in this one. We see total assets 700 million. All right, what about debt? All right, they have quite a bit of leverage. They are more leveraged than a property company basically, but these are not large numbers if we compare it to the income that they have. Regarding ordinary shares numbers, here I would look for dilution to see if they are diluting shareholders. We can see here on the annual basis from 2020, here the COVID year, it has indeed increased in the number of shares outstanding, but this was just a small increase and then a big jump here. So this could perhaps have been that they made an acquisition or that they made some sort of at-the-market offering to do some financing of operation to be able to grow faster. There's many potential reasons here, and then we just see a small increase once again. So they are not overly diluting shareholders. I would say that debt to equity is a bit leveraged here. Debt is quite large compared to the equity side, but this is not something that I'm worried about in this type of business. It's not a capital intense business. They don't have to have a lot of assets to generate the revenue, and these numbers are small compared to total market cap, compared to revenues. That's why I looked at this in the end, because of the service nature of the business. So not quite as important in the analysis as the revenue growth. Let's not get sidetracked here. Let's stay on topic. The most important thing for this stock to succeed in the futures and for investors to make a ton of money is revenue growth to start accelerating once again. If that does, it will get a completely new valuation and stock price will absolutely soar. So I'm holding, crossing my fingers, as you say in English, for revenue to accelerate and for shareholders to make a ton of money. All right, that's been it for this video. And as always, take care. Bye bye.